wrap it up, Siva, with what should a debt investor do? Because everybody is asking about whether we should completely be away from the shorter end, or now there is no need because you believe that chalo bahut ho gaya.
Yeah, no, I think a couple of things stood out for me, and one glaring omission. What stood out for me, of course, I mean, I think Kaushik has answered it. I don't want to go too much into it, but I think the introduction of this new tool, SDF, to absorb liquidity, and of course, they can use SDF to absorb more durable liquidity if they need to, because while they have opened it up today for one-day liquidity, if they need to absorb liquidity on a more durable basis, there's nothing stopping them from acting. But I think that's premature. I think the let them do it on a slow manner. They're also, it appears that they're comfortable in allowing this liquidity to come down over years rather than over quarters. So in that sense, RBI doesn't seem to want to be very disruptive when it comes to liquidity. So raise the price of money, but not reduce the quantity of money. That seems to be their thought process. So when it comes to what they missed, and at least from a mutual fund and investment perspective, there was a lot of expectation that they would do something about this, at least from a mutual funds, overseas investment limits being relooked at. That is an RBI's quote, and has been sitting there for a while. I think a big disappointment that they didn't choose to address that as part of their regulatory policy updates. So I think there is that's something which I think investors would have been definitely looking forward to from the RBI this time. Now, when it comes to investing in debt, like I said, most of the pain or expected rate hikes are now in the price. I agree with Kaushik that if inflation averages no more than, let's say, 5.5%, then we should expect the repo rate to maybe go to the 5.5% band. Markets are pricing in 6.5 or even higher. So there's an opportunity right now, I think, across the yield curve. There are pockets of the yield curve which well, I will not say to just go long duration, but I think there are pockets of value emerging across the yield curve as a result of this big sell-off. So I think there will be an opportunity for investors, especially at the longer end of the yield curve. At the short end of the curve, I think, is where there's likely to be more pressure. Like I said earlier, it's the short end, the 2-year, 3-year, where we have seen the most sell-off today, and I think that is likely to continue. So investors should look at what's classically called a barbell strategy, where you're buying money market or floating rate bonds on the one hand, and buying some long duration bonds, and avoid that sort of middle part of the curve. I would say that'll be a good way to manage your portfolio at this point of time. Floaters, I think, will be hugely valuable in this environment. Given that there's a lot of GSEC and corporate bond floaters available these days, I think floating rate bonds will become very, very interesting for investors again in this environment. So I think there are multiple places. And the last point I'll make here is that 2 years during the pandemic, one big challenge we had as fixed income investors was how to beat inflation. Average inflation was close to 6%, and the entire yield curve was below 6. So how would you, with reasonably good quality, we're talking about G6, AAA, etc. But now, with inflation perhaps going to be below 6%, every part of the yield curve beyond the 2-year, 3-year segment is above 6%. So even to start building a portfolio now which can actually beat inflation on a sustained basis is well possible, at this point of time. And I think real yielding assets will hold value even in a rate hike cycle. So if you buy assets which are significantly positive real yields, AA bonds at 6.5%, 5 to 10 year G6 and AAA assets, which are today now giving you even the ability to go well above 7 in the case of G6 and AAA bonds, let's say the 10-year space. All of that will hold value even in a rising interest rate environment. So I think there's a lot of pockets where I see significant value for investors to hide even in a rising interest rate environment.